Hey everyone, welcome to Small Business Tax Prep. If you're watching online, thank you for joining us. We have only just a very few people here in the room. Most of you will be joining on Facebook Live, which is great. We're in the middle of a pandemic. We wanted to make sure that this was available to you. So we have New Life Media and Productions here to make that possible. If I could, I would love to have you hit the share button right down there. So that your friends who want to start a business or who have started a business, if they need advice on how to get ready for tax season, that they see this. This is going to be huge, very important to them. So please do share this so that we can spread this message as far as we can. Today we have Josh Storts with LWS Tax. He's going to be doing the presentation. LWS has been a great friend of the SBDC, and so we're very glad to have them here as well. I guess that's it. So I hope you guys enjoy this. By the way, we do have a moderator here who will be paying attention to the comment section of this live video. If you have questions along the way, put them down there, and we will relay those questions to Josh so that he can answer them throughout the presentation. So without further ado, I'd like to invite Josh Storts to come up and give us his presentation.
Awesome. Well, good morning, y'all. I am Josh Storts, and I'm with LWS, and I am glad to be here today to really just kind of help you guys out in understanding what goes into doing taxes correctly. And I have some other things mixed in there. There's a lot of different things, and so we'll kind of just get started here. So just the agenda today, we're going to do just introduce myself here, LWS, my firm, and then we're going to do just the setups of small businesses, and then we're going to go into preparation for the tax returns and what the actual returns, and then we'll kind of close that down. Like Rob said, I love answering questions. So if you have questions, make sure you shoot them over, and we'll try to answer those questions as best as I can today for you. So I am Josh, and as you can see, I'm the guy on the far, I guess, left. Maybe it's right, I don't really know. But I'm the big guy over there, and this is LWS. We are just a small accounting firm here in Springfield, Ohio, and we really enjoy helping small businesses. That's one of our things that we just absolutely love, because we actually can see what it does in a small business if things are done properly. It's life-changing when you do your taxes correctly. And I know that sounds crazy, but for any small business, if you do things correctly and you go from maybe owing a couple $1,000s to getting a couple $1,000s back, that is truly life-changing. And so we take pride in doing that. And as you can see, there's a diverse group of people here. Blake started our firm 13 years ago. Brian has been there for 13 years, and then the rest of us have just kind of scattered in as it's gone, but we really do enjoy. So we'll kind of get started here, setting up your business. So it is vital that you start your business correctly. If you do not have a firm foundation of how you set your business up, it doesn't matter if you have great sales, it doesn't matter if you have client interactions, all of those things, if you do not do your taxes correctly and the different things that go along with taxes, your business will fail. And that is a hard thing for people to understand, because they don't realize once you are behind the ball with taxes, it is really hard to get out, no matter what your sales are. And so that is why we really want to set the foundation of your business up correctly. And so figuring out what structure actually makes sense for you. For some of you, as you get started, the best way to structure your business is just going to be running it as a sole prop, just as yourself. And you'll be a Schedule C on your taxes. So for you guys that don't know what a Schedule C is, that's going to be where you actually have on your personal return, you're adding your business in on your personal side. So your business doesn't have a separate entity structure. Everything just flows right there under your business, under your personal side. And so you have structures like that. For some of you, you may have a partner. And the number one thing we see is people who don't understand taxes. When you have a partner, you just kind of cut everything down the middle, 50-50. You do this you claim that, I claim that. Well, that is completely wrong, and you can get hit with penalties and things of that nature if you don't file a proper partnership return. And so that is one of those things. If you are a partnership, don't just separate it out and say, okay, you take $10,000 and $10,000 of expenses, and I'll take $10,000 and $10,000 of expenses. That's going to get you in trouble in the long run, and it's not done correctly there. And so you have to kind of understand that. And then you have different corporations, whether it's a C Corp, an S Corp. Those are different structures that when you get to a certain dollar level, it makes more sense from a tax standpoint. And so that's where it makes sense to walk through this journey of preparing your taxes. And it's not just on April 15th, you're like, oh no, my taxes are due, let me get them done. It's starting now, getting with a professional, whether you have your own accounting person, a bookkeeper, asking them where that profit's going to hit. It's vital to know that type of thing. And so those are kind of laying the firm foundation of where you need to be in setting up is going to be vital to the success of your business. And then making sure setting up all your state and locals. Now, this is one of the things that most people don't do. And with taxes, it starts now making sure you have all of your locals set up correctly. So if you work in Springfield, Ohio, and you make a profit, the city of Springfield expects you to do a return. And then if you also work in Urbana, Urbana expects a return. You do Xenia, Xenia expects a return. So if you're in 5 or 6 different cities, all of those cities expect. Just because you live in Springfield doesn't mean that you don't pay taxes in those. And that's one of those things, if you do not have that set up, you might not get a notice or a letter for 4 or 5 years. And next thing you know, you get a letter in the mail that says, we need to see your profit. And next thing you know, you owe the city of Xenia $1,000 from 4 years ago, and now with penalties and interest, all of a sudden that $1,000 is a significant amount more money. And that's why setting everything up from the very beginning is that foundation to make sure that you do not get that letter in the mail and go, oh no, what did I do? All profit for 2000 whatever wiped out because of a tax bill. That's the scary thing about taxes if it's not done correctly. Done correctly, you don't have to worry about penalties and interest. You don't have to worry about all those anxieties that everybody has because it's done correctly. So let's kind of start on federal structures. The first one is you can kind of just run everything through your Social Security number. That might make perfect sense for most of you, especially as you're getting started and you have a low profit. You know, doing just everything under your social, that is a great opportunity to start a business. There's nothing wrong with that. But for some of you, you might want to create an EIN. And it was funny, I was actually putting this together, and I asked my wife to read, and she goes, you copied and pasted that next point, didn't you? And I was like, yeah, I did. So this is actually from the employer identification number. So you'll see it's the federal employee identification number from the federal tax identification, or a federal tax identification number is a unique 9-digit number assigned by the IRS to a business entity operating in the U.S. So this is what you want to do. If you have to give out your Social Security number to a lot of people, you might just not be comfortable with that. So this is a great way. You can create an EIN, and then you have a personal identification number that isn't associated with your personal self. And so an EIN is a great asset to have when you're starting a business, and that is a great way. Now, why you should create an LLC or an EIN, you're going to have to seek an attorney for that. That is something that I can't tell you why, but I'm going to hop over and I'm going to show you at the state of Ohio. If you go there, they have this awesome little kind of cheat sheet here. And we will scroll down here, and you'll see right here the different legal structures and kind of the reason why and what advantages that has. Now, this is really easy to go to. If you just go to ohio.gov, and then there's like a business little tab up there, click on that, and then there's like resources for business. Once you go there, you click on that, and then there's a start, I think it's called the Startup Guide. And click there, and that's where you can get this. So if you're like, Josh, what's the different structures that you've been talking about? This is a great way to go, and the state of Ohio has put this together so that you guys can actually have all those advantages and maybe not have to seek legal counsel, because this gives you a little bit clearer vision of why.
Once you choose in the beginning, are you stuck with it, or can you change later on?
Yeah, so the question was, once you select an entity structure, are you stuck with it? And the answer is yes and no. So no, an EIN, that's going to kind of stay with you with that wherever. But for instance, like an LLC, you create an LLC. We can actually then take that and designate it as an S Corp. So you can kind of change. Now, like there are certain types of partnerships that you can't go from one to another, but there's different ways that you can go from like a limited partnership. You might have to go to like a C Corp to an S Corp. So there's ways that the government has allowed you to do that, but it is very simple to kind of just switch that up. And that's where you really need to be working with a tax preparer throughout the year, because for some of these structures, it costs money to be those different structures. So like, for instance, one of the things with like an S Corp, which is there at the bottom, you have to run a payroll. Like there's no way around. That's one of the rules of doing it. So from a financial standpoint, it might not be smart if your business is making $5,000 of profit to actually be an S Corp, because you're going to have more costs associated with fees of payrolls and things like that. And so that's where kind of working with, you guys here at the SBDC, working with the bookkeeper, and I know you guys have one, and we'll put her information up at the end, and understanding that profit. That's where it's vital for taxes. If you do not know where your profit is right now and you're a small business, there's trouble.
So if you start as a sole prop because you're not even sure the thing's going to fly.
Yep.
Can you then, like, let's say it starts working, you're making money, you're hiring people, you start to worry that this isn't the right structure. Is it easy to go from sole prop to LLC?
Extremely easy.
Okay.
Yeah, and that's something that you're talking days turnaround. So this isn't like all of these things, it's not like you have a very long period of time. Now, I will say this, because of the current state of a pandemic, there are things that need to be mailed in. So some things do take longer than normal, but for like going from a sole prop to an LLC, that can happen really easy. And there's things like S Corps that you can go back 3.5 years in. So if unfortunately you haven't done your taxes for a couple years and you're like, I've shown a huge profit, there's still things you can do even past the due date. Now, there's different things, and you definitely need to seek a professional when you do that, because there's a lot of hiccups that can happen there, but that is one of the things that you can do. So I'm going to actually hop back to my PowerPoint here. So state and locals. So this is the next kind of part that I think we should really spend some time on, is the Ohio Business Gateway. For some of you may already have an Ohio Business Gateway, but these are two different tax things that kind of roll through the OBG, which that also sounds like an awesome rap name, OBG, but that you might need. And so the telephone number is up there, because the first thing we're going to talk about is sales tax. This is the number one thing that we see small businesses really not understand, and always this is the one that hurts most, because most people don't realize when you should be charging sales tax. For instance, most landscape companies do not realize you should be charging sales tax. And next thing you know, you've run a successful business for 3 to 4 years, and all of a sudden you owe sales tax. And that is not good, because they can put you on, it's called the HOPLess, Habitual Offenders Program. And that's where we see a lot of people hop in when they don't know sales tax. So I actually have a telephone number up here. It's 888-405-4039. If you have questions about whether or not your business falls into sales tax, because there are some gray areas there. I wish there was black and white on everything. Depending on certain different tasks and things like that, you might not have to pay sales tax. The great thing is they actually do listen pretty well, and they pick up the phone a lot quicker. If you've ever called the IRS, right now it's like a 3-hour wait time. If you call the OBG, you're talking 15, 20 minutes max, you're getting through to somebody. Take the time, I cannot stress this enough. If you're not doing sales tax and you don't know if you should, after this presentation, hop on that line and ask. Because if you are your first year, you're not going to be a big problem. If you're 3 years in and you need to do sales tax, you have to start that like today. And so that's a really big deal. That unfortunately we get people who come into our office and they're a sole prop, Schedule C. Oh, I did great this year. Started my own landscape business. I'm $20,000 in. Oh, did you do sales tax? Sales tax? Well, what's sales tax? Oh, okay. Then there's a problem. So make sure you're calling that today. If you have to do it, you have to get a vendor's license. You have to do a monthly due date of the 23rd, which is really funny. In our office, the 23rd, we actually kind of make the joke of it. It's sales tax day every single time, or we're like, it's 3 weeks to sales tax day, because it is so important for our clients, because this is one of those things, penalties and interest rack up very quickly if you're not doing it. CAT tax, this is another thing. If you do over $150,000 in sales, you must do CAT tax. So this is not profit. So a lot of people think it's profit. This is actual, your business sells $150,000, you have zero profit, you still have to do CAT tax. And so this is another important thing that most people overlook. That is one that can be semi-annually. Now, if you go up and over, I believe they just changed the number. I think it's a little over $1 million. Then you have to do it monthly. So if you do over $1 million in sales in a year, then that kind of kicks up a little bit more frequently. But once again, seek out professional help on any of these things if you have more questions on it. And then estimated tax payments to locals. This is the one that they nickel and dime, the cities can, because they want you to pay estimated payments. They don't want you to send in a full payment check of $1,500 April 15th. So this is one of those things that when you know you're going to have a profit and you're going to owe $300 to the city of London, say, something close, you still need to send in that estimated payment, because they're going to get just a little bit of penalties and interest. But we don't want anybody to pay penalties and interest if you don't have to pay penalties and interest. So doing those estimated payments and setting that up, it's super easy. And after 1 year of showing a profit, these cities are on top of it. You're probably going to get in the mail estimated payment vouchers, and you're going to be like, why did they send me estimated payment vouchers? Because they want you to prepay. It is, to them, that is just how they do it. If you pay after December 31st, you're going to get hit with maybe a $50 estimated penalty, not paying estimated taxes. I think that's what it is here in Springfield. So that is one of those things, setting it up, knowing where you stand today, so you don't get those extra penalties. If you're in 5 or 6 cities, you could easily have $500 in penalties, even though you're going to pay your taxes on time. And so that's money that is out of your pocket that you're not going to get, and that's why it's vital to kind of set those things up.
So the estimated tax payments, you're talking about income tax, right?
Yeah, income tax, yes. Well, on all structures, though. So if you're an S Corp where it's a flow-through entity and your business is going to, your S Corp would then have to pay those estimated taxes beforehand. If you're running it as a sole prop through your own, it would still be on your personal taxes. But yeah, it is all income taxes.
But at the state and federal level, they don't require you to quarterly pay.
Well, eventually they do. But as you get started, depending on where your profit stands, estimated taxes, if you owe under $1,000 to the federal, you're going to be okay. And especially if you're getting started, the odds of you showing a big enough profit to make that hit, it's a lot harder is what we see. And especially if you have a W-2 job and you have a withholding, if you're used to getting a $6,000 return and you go to now you only get a $4,000, or a $1,000, you don't need to make estimated payments because you don't owe. So a lot of times we see couples, a partner works a W-2 job, the other one owns the business. This person has enough withheld on their taxes that the person in the small business, they don't have to make estimated payments. Those are the weird things. But they might still have to do it on the city level, on the local level, because a spouse might not be withholding all these other cities. And that's why we see more estimated payments need for locals than on federal.
So does the state and federal government just contact you and say, hey, you've got to pay quarterly?
That is where no, they just gladly just send you a penalty. They just add it to your bill. They're not gonna send out to everybody that does that. But that's where working with a tax professional, like for us, if you come in and you don't show a profit, but you're telling us, hey, I did $15,000 in profit this year, and next year I've already, you come in April, I've already almost done more in sales. Okay, we're going to put together estimated payments to kind of make that work. But it's case by case because of how different everybody is. And that's kind of the hard part on taxes. A lot of people, you'll hear, man, I got a $7,000 refund. And you work at the same place. And you're like, how'd you get a $7,000 refund? Well, what you don't know is they claim 5 dependents. They have an extra $100 withheld on every check. So things are different. So you can have somebody who has a partner that they withhold like that, and you have a business that's still successful, and you still might not have to make estimated payments to state and locals because of that. So it's a little bit different there on the federal and state level. And then businesses are not, you're not going to have to pay income tax if your business is under a profit of $254,000. Don't hold me to that number directly. It's really close to that. In your tax return, you actually get to put your profit, and then that deducts out. So you're not going to actually pay a lot of taxes on that. That's actually one of the good things for small businesses in the state of Ohio. So for most people, estimated payments on the state level in Ohio, not really, you have to show a whole lot of profit. And if you're showing that much profit, you're really in a different realm of tax planning at that point. You're not just, you're doing monthly accounting, a lot of different moving structures on that one. So prep for just preparing for taxes. So let's see here. We're going to talk about 1099s. This is one thing that most people don't do. You have a buddy who works with you. You pay him cash every single week, and next thing you know, at the end of the year, you've paid your buddy $2,500, but you don't want to fill out a 1099 because you don't want your buddy to pay taxes. We hear it all the time. And it is noble that you don't want your buddy to pay taxes, but the government does not like that. So you do not get to use that as a deduction. You pay your buddy $2,500, guess who's paying that taxes? You are paying that taxes. And so it is vital that you 1099 all employees to really make sure that you're getting the full amount of deductions for it. Now this is where it gets tricky because there is a employee-employer, and I'm going to hop to the bottom here a little bit, relationship. If you tell somebody they have to be at your building Monday, Wednesday, Friday, and they work 8 to 5 on those days, you supply everything they need, that is not a contract employee. You should not be 1099ing that person. They are an employee of you, of your company. And so keep that in mind. A contract employee genuinely is a contract employee. If they don't want to work that day, they don't have to work that day. Now that doesn't mean you won't call them back, but you cannot have strict times that they have to be working and 1099 them. And that is across the board. We see that kind of all the time in that. And so 1099s are due on January 31st. You need to make sure those go out. And some examples of why you would 1099. Legal fees. You paid a certain amount of money in legal fees, you'll 1099 them. Rents paid. So you rent a space. $500 a month is what you pay to rent that space. At the end of the year, you need to send a 1099 if you're a business to the person you rent for rents paid. And so you'll get that. So what you need to make sure is W-9s for all contract employees. Must have. Absolutely must have that so you can 1099 them, so you can take that expense. Because if not, that's where it gets tricky. So then interest paid, contractors over $600, advertising. We want you to get the full deductions on those. And if you don't do that properly, you won't get the full deduction. The IRS can choose to throw that out. So if you say, I paid in contract labor $25,000. You 1099 nobody, they're going to be like, you don't have contract labor. Like, you're paying the taxes on that. You didn't do it correctly. And that's where those are the things that you think you're good, and 3 years later when you get the notice, because most audits now, they're not knocking on your doors. It's just, that's a way of the past. They're going to send you a letter and they're just going to say, prove it. Show me where you paid these people. Okay, you can't show it, I can't give you the expense. And that's how a lot of times it works. And so that's we'll kind of transition into the next one. This is go ahead.
So let's say your business had a loss. You spent more than you made, which a lot of businesses do.
Yeah.
Right? And it all flows through your personal income tax statement. Because you had a loss, is that reducing your tax burden? And does that trip auditors to look at it?
Yes and no. Depending on how you're set up and depending on income level, you may be a doctor. Yeah. So the question was, if you show a loss, does that reduce your tax your tax burden? And then also, does that raise a trigger of audit? So for the first part of the question, if you're, say, a doctor and you run a Color Street business, which I don't know if anybody knows what that is. We see it all the time. I think it's the fingernail polish business or Young Living, something like that. And somehow you lost $4,000, but you made $1.5 million. It doesn't work that way. You can get a carry forward. So it depending on the circumstance. Now, if you make a certain amount of money and you lose $4,000 or $5,000, yes, that could reduce your tax burden. But that's on a case by case, and there's a lot of different just different things in there. Does it trigger a red flag? Depends. There's certain ways that you can lose money that it wouldn't trigger a red flag. You bought some equipment. You're depreciating that asset. You show a rough loss. That they're going to look at that return and they're going to say, okay, this makes sense. Like you bought a $100,000 backhoe because you do excavating. It's the first year that you've done it. You showed X amount of loss. They're not going to do that. Now, if 5 years in a row you show, a $50,000 loss, there's a good chance they're going to be like, okay, what are you doing here? Like, you need to be in business to make money, not lose money. So I would say, now granted, most people don't get audited, but your likelihood, possibly, with computers nowadays, everything goes in electronically. We know that you have an algorithm that certain things probably do produce red flags. With that said, we're not privy to that information. So we don't know exactly what they're going to look for. But for instance, like S-Corps, reasonable compensation. They hired an extra 2,700 auditors for reasonable compensation last year. Well, it's then you can look at the data and say, okay, you hired 2,700 people for this one specific thing. It's probably going to become a hot button issue to look into reasonable compensation. And that's where having a professional who's telling you, hey, make sure you're doing this, that really helps. But overall, the number one thing you're going to see audit-wise is going to be miles, which is one of the next things. Because what you will see is somebody says, how many miles did you drive for your business? 17,000 miles. Oh, you drove 17,000 miles on the dot. That doesn't make sense. Do you have any record of that? No, but I drove, I went to, Lancaster 3 times last year. I went to Toledo once. Like, that's a lot of miles. It's probably 14.5. That's the easy thing that's going to be audited. And that's why, I always tell people, Mileage IQ, it's like the best $6 app you can spend. Because you're going to get a log, and it's going to log everything. You can swipe it. If you do QuickBooks Online, which I know you guys have a QuickBook Pro helper. On QuickBooks Online now, they have a mileage thing. And you can just swipe. Is this personal? Yes. Okay, it doesn't log it. Oh, it's business? Yes, it logs. Those are the type of things, because they're just going to send a letter and they're going to say, prove your mileage. And then if you have nothing, you're going to have to try to figure out, you're not going to be honest, because if they send you a letter 3 years, there's no way you're going to be able to be like, oh, I went to Lancaster 4 days 3 years ago in March, and I went here. There's just no way. And so those are the types of things that really can scare people. It's the biggest deduction on most small businesses is mileage, because like this year it's 57.5 cents per mile. So that adds up really quickly. And so that's how a lot of people show losses, is because of mileage. You just have to prove it. And so, yeah, that's the big one. Just get the app, track it, and you're not going to have any issues. The other big thing that we see is lack of separation of personal and business. I can't stress the importance to have a business account and a personal account. Or if you run to Walmart and you're buying office supplies, you got a ream of paper, a thing of pens, and a desk lamp for your office, and then you have milk, eggs, bread here. Don't put it on the same receipt. Like that, you're blurring lines that don't need to be blurred. And so keep a separate bank account, keep a separate credit card to keep those transactions separate. Because that's the number one thing when you're going at the end of the year, because most people don't keep a P&L active throughout the year. QuickBooks, I think I actually have it up here maybe, or maybe it's on the next slide. Do QuickBooks, do whatever software you want, Excel, whatever it is, just keep records from the beginning. Because at the end of the year, if you mix personal and business, and you're going through your bank statements because you're like, oh, I know, I only bought from Office Max, boom, you're going to lose a lot of expenses because you didn't realize, oh, when you went to Walmart that one time, you bought X, Y, and Z for the business and this for the personal, and you see $125, and you're like, I don't know what that is. So you're either going to take it all for business, which is wrong, and if you get in an audit, that's going to get thrown out and you're going to be in trouble, or you're not going to take it because you're doing the right thing, and then you're paying more in taxes because you just didn't do it correctly from the beginning.
There's also like legal risks you take when you commingle funds, because then an attorney can say it's not separate. We can go after everything you own.
Correct. Which that's on a legal side. That's not an accounting side, so I'll stay away from that. But there is a lot of truth to that. The next big thing is keeping up with your P&L. It is critical to your success. You need to make sure every single week, every single day, you're going through and putting in whatever system you have. And some people, you're wizards on Excel. Excel is perfectly fine. You just have to have a system that works, that you're tracking everything. Because if you get to the end of the year, it's not going to work. If you're sitting and you have a shoebox full of receipts and you're sitting there, you have a whole lot of trouble happening really quickly. The next thing is really don't forget about different retirements and health insurances. As a small business, you can still do that. And there's a lot of different ways that you can set up to pay in to retirement and health insurance that you can use that as a deduction. Depending on how you're set up, if you're a small business, you can actually put your health insurance into your business. And you can use that as a deduction to your business. Depending on where you are profit-wise, you can set up a retirement through your business, and that's more structured too. But say you're an S-Corp and you have $50,000 of profit, which is uncommon. You can actually say, I want to set up a company match this year where I am going to do X amount percent in, and then you actually can use that percentage as a deduction. So there's a little bit different there on how to set that up. But the deductions are the number one thing that we see people just making up. And we're like, sorry, we can't use that. We just need true statistics. So advertising, if you spend $15 a month in Facebook advertising, that's a really easy thing to just put in and say, okay, this year, I spent X amount of money on Facebook advertising. Boom, it's there. Keep the receipts, keep it clean. Home office use, it has to be a designated space. So you can't say, oh, I use 150 square feet of my 1,500 square feet home as a home office. Oh, okay, great, that's cool. Where is it? Well, I do. I just work in my living room. Oh, okay. Do you do anything else in your living room? Well, yeah, I watch TV. My kids play. I have fun. Well, that's not a designated space for it. So that's where a lot of those different things, people think they can get away with it, and you might for a certain amount of time, but in the long run, if you want your business to be successful, you have to do everything right from the beginning. And so doing different things like that. The other big thing is people want to claim gas, insurance, and mileage. You can't do that. So that's another one that you might be keeping a great mileage log. You keep all your gas receipts. It's one or the other. You either get to claim miles or you get to claim actual expenses, which would be your gas, your insurance, repairs, oil changes, all of that. For some people, truckers, it almost makes sense more to go with actual expenses. So if you're a trucker, miles, it seems like would be really good because you might drive 100,000 miles, but you spend so much in fuel, oil changes, tires, repairs, that a lot of times with truckers, it actually works out to their advantage to use actual expenses rather than using miles. So for your business, you might have to look at the different ways, because you might run a home business that you make a highly profitable amount, but you only drive a couple thousand miles a year for that. It might be better to take actual expenses. And so those are different things that you kind of have to think of. But that is something, we run both sets of numbers. So you come in, you say I drove 10,000 miles. It's really easy because we know that the number is 57.5 cents. And you're like, well, with gas and fuel, I drive a pickup truck that gets 4 miles to the gallon. It's awesome. And you're like, it gets 4 miles to a gallon. I don't know how awesome that would be. But that's one of those things that actual expenses might make more sense for you.
Josh?
Yes.
In your experience, does it seem like most small business owners are leaving money on the table when they don't use an accountant, or is it the opposite where they're claiming way too many deductions that's not appropriate? Like, you often find you save a lot in taxes by using an attorney.
So the question was, does it save you more money to use an accountant, or do they write off more if they don't? So the answer is yes to both. A lot of people don't do it correctly, and so they write off a whole lot more. So doing it correctly, they would pay more because it's done correctly. And so, when somebody comes in and they're like, okay, I have this, this, and this, and you're like, oh, you gave, $5,000 to this charity, but that was just through your personal self. That wasn't a business deduction. Some people they might take that as a $5,000 marketing thing. It's like, no, you just gave $5,000 to your church that you tithe every single week. Like, that's not a business deduction. And so there's different things like that. But for most people, when you have monthly accounting, you end up saving usually, like for us, I always tell people when they ask, we're going to save you more money by having us than not having us. Because when you have somebody doing that kind of accounting for you, and they're actually looking out for your best interests, you're getting a snapshot every single month of your business. And so there's no shocks of you walk in March, you're like, because everybody already has your tax return spent before you even get it. Like, people walk in and they're like, if you're used to getting an X amount, you've already spent, if you get a $3,000 return every year, you've already spent that $3,000 when you walk in the door. You're like, I'm going to buy a new TV. Oh, I got to fix the car. We're going to put new carpet in. And then you get there and it's like, okay, you owe $1,500. Whoa, what happened? Well, you showed $50,000 in profit last year. You showed a $3,000 loss. I didn't even realize that. I just had all my expenses. I didn't have it added up. Where an accountant, this time of year, I'm making phone calls all day, every day saying, are you doing this? Where are you at? Have you been doing this tax strategy that we told you? Okay. We're setting them up so they don't have failure during tax season. And that's why working with a professional, working with your guys' QuickBooks tutorial person here, it sets it up that you have success so you know and you can plan accordingly. And that's the number one thing. If you aren't planning accordingly and you get hit with a big tax bill, you're shocked, and you might not have the funds to pay that. Then you're fighting that uphill battle of paying off the IRS, paying off all these different entities because you just didn't know. You thought you had money to go and buy that new piece of equipment, but you really didn't have the money to buy that. And for me, that's one of the things that I try to steer people away from is buying not to pay taxes. Like, don't buy the $40,000 truck or the $25,000 car because you don't want to pay taxes. You're looking at your numbers, you don't have the funds to do that. Like, you thought it was better to spend $40,000 not to pay $2,500 in taxes. Like, that's really not setting your business up for long-term success. And that's where working with a professional, and honestly, in Clark County, we have phenomenal people throughout Clark County. Obviously, I'm biased and think LWS is by far the best, but that does not mean whoever you're working with, I guarantee they're probably pretty good. They will have your best interest if you come in and ask those questions. And that's where, to me, it's vital to be working very routinely with your tax professional because it just makes more sense. So the different types of tax returns. This is one of those things that, going back to the very first statement, you have a partner that you do business with, you separate it out, that's where you can kind of get in problems when you really should be filing a 1065 partnership, which it was really funny. I put this together and I was kind of running over it with my wife, and she's like, what do these numbers even mean? And I was like, oh, that's kind of funny. I do this for a living. You have no clue. I go, but honestly, that you're probably like most people out there. You have no clue the difference between a 1040, a 1065, 1120S. You don't have any idea of what state filings you need to have or handle. And so for you, as you set up your business, you thought you went on to LegalZoom, you and your partner, you filled out your partnership paperwork, you got that SS4 in the mail, and it shows both partners. Well, you guys just split the income and you put it on your 1040, your personal return. Well, now you ask if a red flag goes up. Well, you now didn't file a 1065 return. You've already told the IRS you are a 1065 partnership. They know you're a partner. You don't file it. The letter isn't going to come instantaneously. So now you're a few months in. This time of year you might get a letter. Well, actually, they might have thought you would have filed an extension. So come March, you might get a letter that says, hey, did you forget to file a 1065 partnership return? What's a 1065 partnership return? Like, I didn't even know that. That's where working with a professional, working with you guys to understand what type of return you need to fill out is vital. The state filings. So most people don't realize if you do work in other states, even though you live in Ohio, you still need to do that return. Now, we do have a lot of neat things set up with like Kentucky, Pennsylvania, Indiana. You work there. Our taxes we can offset there. But say you're a welder and you're a small business welder and you travel throughout the year, which is very common with guys who are in the welding industry. We have a lot here in Clark County, and you work on a pipeline, and that pipeline starts in Missouri, and you work your way up. You need to be filling out tax returns for all those states as you go. And so that is where, for some of you, you're going to work predominantly right here. There's nothing wrong with that. But for some of you, you're going to have multiple states. And then kind of hitting on the locals again, for all those different cities, I cannot stress it enough. This is the number one thing. The federal government, state are really easy to work with. It seems like locals, they are going to get their money. And small businesses pay probably a large chunk of that. And so they're going to come after you if you don't do it correctly. So it's essential to really be making sure you do that. And the other big thing is making sure you file on time. I can't stress that enough. Don't wait and do it on odd years. Like we see people, oh, it's an odd year. Oh, he'll come in and we'll do 2 years. Like, getting behind is not good. Every single year on time. If depending on how you're set up, some people, your taxes are actually going to be due March 15th. depending on different structures. If you're not going to get it in by then, file the extension. You have now until September 15th. If it's on a personal side and you're not at a point in April, file the extension, but actually file the extension and then make sure it's done by October 15th.
How does a city know I did work in their city? And then, let me ask that one.
So how does a city know they did work? Well, a lot of times people will 1099 you, and they'll send copies of it to the city too. For instance, like real estate, that's a big one. It's really easy to see what agent sold a property. So, okay, not to say that they're fishing, but they find out. And a lot of times it's somebody does something to say, okay, this person did this. Or you do something and you don't realize you're working for the city. And next thing you know, you get a letter. I think people think that they can just get away with it. There's so many ways to figure out where people do business. And, not to say they're driving and you have a big truck that says, whatever your company name, and it's parked outside City Hall every week because you're doing building. They might just hop on their computer. I wonder if they filed a return here. Oh, they didn't. Send them a letter. So, yeah.
Where do you draw the line? Like, what is doing work? If I've got customers all over the country,
yeah.
To ship them stuff, I'm not really doing work.
21 days. That's what we would say. 21 days. So if you've done work in there for 21 days, unless it's certain, like a realtor, you need to be paying because it's a one-off thing. It's probably been on the market for more than 20, like closing time there, you have more than 21 days. And so that would be kind of the litmus test, I would say, to do that. Now, it will never be a problem if you overfile cities. So your profit is next to nothing in that city. It's better to file a zero return. Say a lot of people are getting into the rental space now. They love rentals. And you hear a guy like, what's his name? Grant Cardone. We'll 10X it, whatever that is. I can't take that. But that's a new business model. A lot of people do that. Well, they don't realize just because you have a zero in a city, you still have to file a zero return for a city. It isn't just if you make profit. So you lost a couple $1,000s. You still have to file that city return. And so that's where it's vital no matter what to file that return. But yeah. So I know we kind of talked a mile a minute there, but what questions kind of do we have? I know we've been answering them as we go, but honestly, taxes are one of those things that everybody's circumstance is completely different, and so you may have questions that don't apply to others, and that's where sit down with a professional and sit down with somebody who kind of knows what they're doing, because it is vital to have that. So here's my contact information. Feel free to contact me. It's just josh@lwstax.com. And our team, we have kind of specialists in all areas. I really take pride in tax planning. I love when people come in and they're like, how does Jeff Bezos pay less in taxes than me? He's just using the tax law that is there. And so every small business, you have the ability to reduce your taxes if it's done correctly. So hopping on TurboTax at 11 o'clock on April 15th, you're going to owe more taxes than the common person. But if you're working with a professional, we're going to put in this strategy. We're going to do this. Okay, you need to move this money here through this. This is the legal way to do it. Those are the different things by working with a professional that you reduce your tax burden. And at LWS, that's where we really love to help small businesses, is that strategic tax planning, and everybody's plan looks completely different. And that's where I take pride in saying, okay, you have $70,000 in profit, but you have 4 kids. Okay, it actually doesn't make sense to change you to this entity structure because you'll lose this on this side. Where you Google it and it's like, oh, this makes sense. Well, for your circumstance, it actually might not make sense. And so that's where working with a professional is kind of a big deal.
How would you answer someone's question who says, I don't know how much to hold back for my income taxes as I'm making money throughout the year? I mean, what's that percentage?
Yeah, so somebody, the question is, somebody asked, how much should I be holding back throughout the year? I know I'm going to show a good profit, so how much should I hold back? That's a difficult question to answer without seeing everything. And I know that's a bad answer, but it's the correct answer. Because depending on, once again, you have a spouse, say the spouse is a nurse, makes a good living, you have 2 kids, they withhold at single and 0 still, not married and 3 or 4. They probably withhold enough taxes so you don't have to withhold taxes, depending on your profit. Now, you are a single person and you have 0 dependents, and you are going to make X, Y, or you're going to make $50,000 of profit. It's really easy to hop on and look at the different tax brackets. So, okay, the first $19,900 and some odd dollars is going to be at 10%. The next is going to go up to 12%. The next goes up to 22%. And it's easy to piece through really quickly. And if you call any tax company, we can quickly say your profit, what you're single, okay, oh, you're filing separate, married filing separate, you're claiming no dependents, okay, withhold this. But really it's profit, what your profit is, and then all the other stuff are highly important on coming up with that. But most people are like, if I withhold 30% of everything, am I going to be good? Yeah, you're probably going to have more than enough for the common person. Honestly, withholding 20%, you'd probably be fine. But it's a case-by-case basis, and that's where it's important to work with a tax professional. But with those tax brackets, I mean, you can Google those online, see the tax bracket. It's not hard to plug that in and see where you're going to land to give you a rough number to save.
This might be a dumb question, but what's the difference between a bookkeeper and an accountant?
The difference between a bookkeeper and an accountant. Well, it's really interesting. So we work hand in hand. So we have our bookkeepers that put everything in to QuickBooks, plug it in, do it. And then our accountants are who are going in and reconciling and doing all the different stuff in there. So a bookkeeper is really good to have to put everything in your QuickBooks, make sure everything is going in correctly. Really, they're the person that just makes everything stay clean. And then the accountant is the person who takes it to the next level and really make sure everything is flowing in correctly, coming up with those different projections, coming up with a balance sheet. A balance sheet for anybody is important. That's kind of the snapshot of your business today. Everybody should be having a running balance sheet on top of a profit and loss. And that's where the accountant's going to be doing all of that, where the bookkeeper is going to just be putting that in. But yeah. Okay. So, and then I do know, Rob, I'll let you, you guys have a bookkeeping expert, and I'll kind of let you run through Nancy.
Thank you. Is this one on, Seth?
I believe so.
Okay. So Josh is right. We have a QuickBooks Pro advisor. Her name is Nancy Tebow. And you have free access to Nancy. Nancy, so she will not do your bookkeeping. That's not what we do. We're not outsourced help here at SBDC. Our job is to make you a better business owner, to coach you. And so what Nancy can do is, let's say you have QuickBooks online, but you just don't know how to use it, or you've just screwed it up royally. Nancy can kind of help untangle that. She can teach you how to use the program. She can tell you, oh, I would not do it this way. I would actually do it this way. She can help you build reports. Basically get you up to speed so that you can handle the finances on your own the best way that you can. That does not mean that you still don't need to have an accountant that you rely on. It doesn't mean maybe that you shouldn't hire a bookkeeper who will come in every week or every month and input all your receipts and payments and all that kind of stuff. You may need that. Get it off your plate. It allows you to focus on more important things. But I did want to make you aware that we have a resource here who can help you if your numbers are just a mess and maybe you're just not in a great position to hire a bookkeeper and pay. We can teach you how to be your own bookkeeper. One last thing that I wanted to point out, just because we see it here at SBDC, is that when you are, I'm going to call it fudging the numbers so that you don't show a profit year after year after year so that you can avoid paying taxes, that's potentially short-term gain, long-term pain. You may get to the point where you want to go get a commercial loan, or you may want to sell your business, but yet year after year after year, you've shown a loss in your business. Well, I don't know too many people who want to buy a business that shows a loss every year. And I hear people say, well, it's profitable. I promise you it's profitable, even though none of my statements say that. That's where fudging the numbers can hurt you a little bit. If you're paying taxes, it means you're making money. That's generally a good thing. You want to do this well. You don't want to pay more than you should, but you do want to be truthful about it. So there are a lot of legal questions and accounting questions that we certainly can't answer at SBDC. We are not the experts in it. We don't have the education that a CPA would have or an attorney would have, but we can help steer you in the right direction and sometimes answer basic questions. So I want to thank Josh for coming in. Thank you for tuning in. If you stuck with us, if you're watching this afterwards, appreciate your time. I'm sure Josh is more than happy to have a phone call with you or email with you. Same here at the SBDC. We want to get you moving in the right direction. And if we need to work with you one-on-one, that's what we're here for. So take advantage of it, guys. Thank you and have a great day.